These are by far my 3 favorite tax breaks that I guarantee you don't know about.
My name is Chris Roach. I'm the CEO of CATAYLST Consulting, a full-service demand generation agency that specializes in partnering with early-stage B2B SaaS companies.
First and foremost, we're going to start off with an easy one, which is travel expenses. Now, as long as you're traveling for business purposes, that travel expense is going to be tax deductible off your income at the end of the year, as long as you're leaving your place of business. So for instance, I live in Milwaukee. If I'm traveling outside of Milwaukee for any business event or to meet with potential clients or to meet with current clients, that entire business trip, as long as I'm working the whole time I'm there, is instantly deductible off my income at the end of the year. This doesn't matter if I fly, if I get the train, or I drive. There are different ways that you can deduct that travel expense off your income, but it's important to note down when you travel, the dates you traveled, who you spent time seeing with, and if you are deducting by the mileage, to actually track your mileage that you actually put down on business compared to any personal mileage throughout the duration of the trip. Secondly, and this is where it gets a little bit fun, this is going to be section 280A, which is the Augusta Rule. Now, for many of you, you've heard of Augusta from the golf because of the Masters, and this is where this rule actually originates from. The Augusta Rule states that you can actually rent out your house for up to 14 days if you own the house without having to claim that income on your tax statement at the end of the year. Now, why does this matter for you as a business? So as a business owner, what you can actually do is now rent your house for up to 14 days a year, deduct that as an expense for the business, but you don't have to claim that income as a personal income as long as you rent for under 14 days. The best way that I found to put this through the business is to actually hold my monthly shareholder meeting at my home, where CATAYLST will actually rent out my house for 1 day per month, so up to 12 days per year, which is under the Augusta Rule for the 14 days. You can rent your house for a going rate, which depending on where you live could be upwards of $300-400 a night, or could be as low as $100 to $200 a night. Either way, that's potentially an extra $2,500 that you can deduct off your income just by knowing that this rule exists. And thirdly, my favorite one is section 179, which is for accelerated depreciation. Now, it's important to note that this rule is actually changing this year. 2022 is the last year for 100% bonus depreciation. In 2023, it is unfortunately going down to 80%, and it will continue to go down 20% every year. Section 179 states that anything that is put into use for the business in that year can be accelerated depreciation, so you can actually take the entire purchase amount off your income. For instance, if you need a new laptop and you buy it between now and the end of the year, you can actually deduct the cost of that laptop off your income because of this bonus depreciation. Next year, you will only be able to deduct 80% of the entire value. Where this becomes very interesting is when you start to apply this to vehicles. And in order to qualify for the section 179, the vehicle must weigh over 6,000 pounds, which is a handful of SUVs and the majority of full-size trucks. So if you choose to purchase a company vehicle, let's say for $40,000, and you have an income from consulting that year of $40,000, you can actually deduct the entire amount that year and effectively pay zero income tax because of this rule in the IRS code. Now, I know what you're thinking. I don't have $40,000 cash to be able to purchase the truck to actually then go ahead and depreciate it. And that's actually not technically how it works. So you can actually purchase the truck this year, you could finance that over the next 6 years, but you can still take the full depreciation this year. So you might only have to put 20% down. So for instance, on a $50,000 truck, you put $10,000 down. You can actually deduct $50,000 off your income for this year, which if you're in that second tax bracket, which most people who have a full-time job will be, you're going to save yourself another 22% on that tax. Now, I know I've thrown a lot of information at you, and I'm sure there are going to be some people with questions, so feel free to comment below, ask any questions that you may have, or if you are interested in learning more and you decided that you do want to launch your own consultancy firm, I am currently putting together a course that's going to help teach full-time marketers how they can earn an extra $10,000 a month by starting their own consultancy firm, and it's going to have everything from how to prospect, how to close, attract new clients, to even how to minimize the taxes that you pay when opening your consultancy firm.